Welcome to Market Call. I'm Matt Scooby. Greg Newman is on the show today. He's Senior Wealth Advisor and Portfolio Manager at Newman Group, ScotiaMcLeod, and he'll be taking your questions on North American Equities. Here is how to reach us. You can call toll-free 1-855-326-6266. You can also email us at marketcall@bnnbloomberg.ca. Greg, great to be with you. Thanks for being here today.
Thank you very much.
Let's get into it, shall we? U.S. equity is a little more expensive right now, kind of outlining that a little bit. We've got some interest rates coming. What do you see? What's your outlook here for the next few months, markets?
So, it's a great question because you've had these mega gains, right? And we are in September, we're going into October. These are the seasonally weak periods. And you have big investment houses like Goldman Sachs that are saying, we've had so many good returns for so long, there's got to be regression to the mean for U.S. equities. 30% odds of recession, they say, and they say the next 10 years aren't going to be so good. So that's one thing. But on the other hand, you have very powerful tailwinds. You've got this big, beautiful bill that has been passed that is very stimulative. You've got interest rates, probably another 2 this year and more coming next year, which are very, very stimulative. And you've got all this AI technology that's proliferating that is delivering a lot of spending, a lot of demand, a lot of productivity gains eventually. So you've got these two things going on at the same time. But the question is valuations. And parts of the U.S. have gotten very expensive. You look at, the AI and the Mag 7 that we own a lot of. And, a lot of people have been saying for a very long time that it's a very, very narrow trade and be careful. But that didn't mean that it wasn't going higher and that there wasn't value there. And there was. We're at a point now where still NVIDIA makes sense, Amazon makes sense, but the other five are getting a little bit pricey, a little bit over their skis. But that doesn't mean there aren't a lot of other pockets that are very investable here, like the small caps.
Let's talk about that, yeah. Small caps, I know you have a couple little pockets, a couple little areas where you still are very ambitious and like a lot right now.
Well, yeah, just because, you have the top 7, the Magnificent 7 that are getting a little bit tired and showing some signs of exhaustion. Financials here are on fire. They're still way cheaper than the group. They've got all this deregulation behind them. You've got an upward sloping yield curve. You've got strong capital markets activity. Then you've got aerospace and defense. I mean, that is a theme that they're spending all over the world, in Canada to meet our targets, and in Europe and in Germany. Gold equities, if the price of bullion stays where it is, gold equities are trading a lot cheaper than they ought to. So, these are 3 or 4 swaths. And when you're talking about small caps, you're talking about, 10,000 companies. And a lot of them have just, they're very interest rate sensitive. And with lower interest rates and a better economy, we just had, I think, a 3.4% GDP print. There's some real strong tailwinds for those as well.
Okay, so lots of good information. We're going to get into it and be back with Greg Newman of Newman Group, ScotiaMcLeod, who's going to take your questions on North American equity. Stay with us. Let's get into it. We're going to start with an email from Peter asking if Greg could please comment on Oracle. Greg, what are our initial thoughts on Oracle today?
Well, they just had a huge earnings day, right? The irony is the revenue and earnings actually missed, but they see their cloud infrastructure segment swelling from $10.3 billion in 2025 to $144 billion. Like, this is like 10x by 2030. They announced some deals with Google and OpenAI in the last quarter. It's a big winner of the AI boom. And, we're looking at who are the owners that are going to circle for TikTok. Larry Ellison may be one of them, so they could be, involved there. For all the talk of their CapEx, it looks rather asset light to us. And, this is a company, you talk about ones that have had a huge run, but we're still modeling 28% earnings per share growth, 26 to 29, and trading at 38 times, 2027, kind of expensive on a price to growth. But pretty compelling, not bad for that growth, and 27 times 2028. So all in, I don't know that you want to be buying these when they're right at the top of the chart, but for a little bit of a pullback, you can continue to accumulate positions.
Okay, let's go to the phone lines now. Jason is in Toronto. Hi, Jason.
Yes, hello. Thanks for taking my call. Greg, I think you mentioned NVIDIA in the opening. That's what I'm calling about, and I do own it. I am a little nervous at the time of year, but the only thing I will comment is people say that NVIDIA is overvalued, but Costco is trading at 50 times PE ratio. So how do you square that circle? Thank you.
Well, that's exactly the way I feel about it. I mean, great reflection and comment. Yeah, for all the hype about NVIDIA, guys, it's only trading at 28 times 2027. And it is growing visibly at 27%, 25 to 29, 34%, 25 to 28. So the only problem with NVIDIA here is if that growth starts to slow, and at what point do people start to jump ship? And we know that these are cyclical companies. And the difference between them being super successful and not executing well can be a factor of 10 for a company like this, really. That's how exaggerated stocks move, right? To the upside and to the down. So look out below if demand really slows. And the concern is that they're overbuilding in AI. And it's not all going to be needed. And we don't know for sure. And the people that are saying that we need all this AI demand are the people that are benefiting from the rising stock prices, the Sam Altmans and the owners of NVIDIA. So it's a little bit of
hard to project, right?
Well, you always want to be concerned, but the 50 analysts or so that are covering it and scrubbing for the truth and paid a lot of money are saying that they think that this can grow 27%, I think it's still a good deal if what they're saying is true.
Okay, let's go to John, who is calling in from London, Ontario. Hi, John. What's your question?
Thank you, Matt. Hello, Greg. Greg, we're all suffering from the Powell pullback, and we had a double dose last week. So I started looking for stocks on sale in Canada, and I came up with MDA Space for one reason. They lost a customer to SpaceX. Number two, Constellation Software for a few reasons, most notably today, a sudden retirement. What stock is on sale the most? Which one should I add to? Thanks, Greg. I appreciate your opinion.
Oh gosh, between those two, a universe of two, there's a lot of stocks in Canada that are on sale right now, I think technically you got to use the chart for Constellation. I think that software has had a little bit of a harder time with the AI themes here. This is still a build-out model, M&A, good growth, still a fragmented space. Does trade at a reasonable multiple for its growth. It has been an incredible wealth builder for anybody that's kept it for 20 years or so. I'd be more of a buyer than I would be a seller. I think you want to use the chart, and you want to be adding more positions.
Yeah, and clearly we're down today after the news too. Let's go out to the West Coast, shall we? Sal is in Vancouver, BC. Hi, Sal.
Hi there. Yeah, my question is on Thomson Reuters. This seems to be one of those companies that's fallen out of favor in this AI play, similar to, as you mentioned, Constellation and some others. I was wondering, what are your thoughts on Thomson Reuters in terms of a future outlook, and do you think now is a good entry point? Thanks so much.
Well, I like this company, and they have their 3 or 4 segments, and they're all benefiting from AI. They beat on their quarter, but the market wasn't happy with their guide. Their forward guidance wasn't as positive as what the market was looking for. Look, my problem with this, and my problem has been this way for 100 points already. It's very richly priced. It's trading at 41 times 2027 with only 11 to 12% growth rate. For me, that's not enough. That's like a Crowd or a Palantir or a Shopify, which I think are all things being equal, more exciting plays. But so I wouldn't be buying it here, but we do have some, and we're holding it and letting it ride.
Okay. Let's sneak one more two in here before we take a quick break. But Lee is in Edmonton, Alberta. Hi, Lee. What's your question?
Yes, good morning, Greg. The question is on AVAX Technologies. Trades on the venture under the symbol ABXX. Could you discuss the key elements in their current business plan, and also maybe rate the competency of the management team, and finally make some comments on the balance sheet and their financial standing? Thanks very much.
Well, that's quite a list. So, I was lucky enough to be at one of their road shows when the stock was around $5 or $6. It couldn't get out of its own way. And I was super impressed with the management team and their vision. And these guys came from Goldman, and they seemed like they were playing for real. And it was trading commodities that aren't currently being traded. And the stock, there's a lot of excitement. There's a lot of very big investors behind it. Listen, it's speculative when you have no earnings. And it still doesn't really have earnings, but the stock has just flown, caught a bid up to $30. And all I can say is with these very whippy speculative stocks, you kind of just got to, if you like the vision, you got to take a chance and you got to pay to play. And we do own some only for suitable clients where there's, they're okay with owning 10 of these things because 7 or 8 might not work. But this one seems to be the real thing so far. And I think it's capable of going further.
And you like getting in right now at that 31 or not?
Oh, gosh.
Would have been better, clearly.
It would have been better at 6. Now it's at 30. Look, I think that, it's thinly traded. If you don't have some and, you like the story and you've gotten to know the story, I think you got to put a downstroke. And of course, when you buy, it's going to go down. Mm-hmm. And then you got to add to it and that sort of thing. But I'm just kidding. Hopefully it doesn't go down as soon as you buy. But often with these kind of must-own speculative names, you kind of get compelled in. And sometimes you make additions at not the best time.
Right. Okay, we're going to be back with Greg Newman of Newman Group, ScotiaMcLeod, taking your questions on North American Equities. Let's go back to the phone lines now, shall we? Alfred is calling from Mountain View, California. Hi, Alfred.
Hi. Good morning, gentlemen. We call Trump's bill the big, bad, ugly bill here in California. Anyway, I would like to know your guest take on Berkshire Hathaway, medium and long term. Thank you, and I take my answer off the air.
Thanks, Alfred.
Well, listen, how can you argue with the wisdom of Warren Buffett, right? Berkshire Hathaway has got great holdings, very patient long-term capital. Most people aren't patient enough, to invest like that. Most people are looking day to day, to a certain extent, quarter to quarter, or month to month, and they don't want to be holding some of these stocks like Chevron that are, negative forever, but seem to really power through in the portfolio longer term. So, I don't think you can go wrong. It's like owning an ETF, but a very, very good one. But with active management and stewardship of Warren Buffett. So, look, I'm a fan.
Mm-hmm. Fair, totally understandable. Caleb is calling from Winnipeg, Manitoba. Hi, Caleb. What's your question?
Hi, Greg. Could I please have your thoughts on Propel Holdings? Do you think right now is a good time to buy? Thanks for taking my call.
I do. I mean, last quarter they had record originations, earnings. Momentum continues, up 22%. Very good loan balances. We think that there's a Goldilocks opportunity here where uncertainty rises in the marketplace, yet the economy only weakens marginally. And, a lot of people have not a lot of access to traditional credit. So this is an online lender. And AI has really helped identify qualified candidates. So PCLs and provisions for credit losses, that should help. And when you shake it all out, I mean, they're, I think, 90% in the U.S., so people have been worried about the Canadian marketplace a little bit, but they've got growth in the U.K. This is a very reasonable multiple. It's trading around 12 times 2027, growing at around 31%. So I like it. I mean, I don't think it gets the respect that it deserves, but I think you got to own it.
Okay. Another caller, Ryan, is in Saskatoon for us today. Hi, Ryan, go ahead.
Oh, hi, Greg. My question's on CNR. Just your thoughts of CNR at these levels. It seems to kind of get about to the $127 range there, then the market seems to like it and it goes up. Just wonder if you like CNR or if you'd prefer CP. Thanks.
Well, I think CP is the better value on price to growth. I think CNR still does work. And I think the transports have all had a bit of a hard time here. And JB Hunt, big trucking company in the States, just guided, the other day, not so good. So it's a bit of a struggling economy. And then there's concerns. I mean, it's such a bifurcated economy, right? Because there's parts of it that are really humming, but the freight hasn't been doing so well. And then there's, also the concerns about free trade and ultimately where that's going. So I don't think you're in any hurry to buy the rails. Mm-hmm. I think that they're good singles. You can hit nice singles with them if you buy them at the right time. I wouldn't say CNR is right there right now.
Okay. Jim is calling in from Peace River, Alberta. Hi, Jim, go ahead.
Thank you for taking my call. Calling about Cenovus and the potential of them taking over MEG next month. How do you see that going through, and how will that affect the share price? Thank you very much. I'll hang up and listen.
Thanks, Jim.
Well, I do think that there's going to be a lot of consolidation in this space. I do think that you've got really, really good tailwinds. You've got the federal government that really is intent on getting our resources offshore for the first time in many, many years. And that is coming together. At the same time, you've got LNG Canada that has been slow and had a lot of maintenance issues this summer, but is up and operating. So Cenovus has been cheap relative to the group. It's had a bit of a higher debt profile, which has been part of it. They have said that by 2026, they want to get that in line and then accelerate shareholder returns. And listen, if they can pull off a merger and if it is strategic, then that'll be very good for the stakeholders.
Okay. Next up is Jeff, who is in Halliburton. Hi, Jeff. What's your question? Jeff, are you there?
Yes, I'm here.
Go ahead.
Hi, Greg. Thanks for taking my call, and I'd like to offer my kudos to your support staff answering the phone. They do a great job.
They are awesome behind the scenes. What's your question, Jeff?
My question is based on Kyndryl Holdings. A while ago, Greg had talked about it. I don't remember if it was a past pick or not. I was wondering if he still held it, if you'd like to going forward for a fairly long-term hold. Thanks, and I'll listen to the reply.
Of course, so these were the guys that were spin out from IBM. And their latest quarter, they missed on their top line. But we think that the stock is still enormously attractive. Listen, their earnings per share still beat last quarter by 2.6, and they reiterated their 26 guidance. So I really like it. It's a bit of a rocky area with geopolitical uncertainty. I mean, that's what they blame their top line miss on. But this stock is not at all, does not get the respect it deserves. It's trading at nine times 2027 and growing at 50%. So I think it's very well positioned in IT infrastructure and in the expansion of global enterprise. So I think you buy it. Continue to buy it. Yeah.
Okay. We're going to get to an email here from Max. Max says, rather, got a few shares of Southbow 2 Corp from TC Energy, and year to date, it has done a lot better than TC. It pays nearly double the yield. So is it safe to buy at this point?
Is it safe? Yeah. I think it's really safe. I mean, what's not to like maybe is they had a leak, on leak 171 incident, but that appears not systemic, and I think the market's pretty satisfied that that's the case. I think technically it's at the high end. You can see on the chart there it's a little bit overbought, but safe, yeah. Payout ratio 71% for a dividend that is 7%. Valuation is quite well anchored, 14 times versus, its peers, TransCanada and Enbridge, more like 18 and 20 times. They reiterated their guide. They got very high quality, high contracted, stable cash flows. So bottom line, question is where do you buy it? We own it. I don't think you add to it here, but 10% earnings per share growth, 14 times, throw on a 7% dividend. Maybe you do buy it here. Maybe you can add a little bit here, but I like to use the chart, and I think that we're probably going to have some sort of pullback sometime in the next few weeks. So I would probably wait and add then.
Okay, you talked yourself into that, I think, as you're saying it out loud. So when we come back, we're going to have a look at Greg's past picks. Stay with us for those. Let's have a look at Greg's past picks. These are from September 16th of last year. We touched on financials a little bit earlier in the program, and past pick is Manulife for Greg. This one, again, modest return, up 11%, 16% overall here in the last year or so. But Greg, we're holding this still, at least at this point?
Yeah, we're still holding it. I mean, we picked it at the time for a single or a double. At the time, it was a bigger discount to the group. Earnings quality were improving. This is still the case. Although last quarter they did have some negative experience in the U.S. and a jump in PCLs. The market didn't like that. But they are acquiring Comvest, which is, they're building out this private credit asset management platform. They have about $3 billion that they were doing it with, and now this is going to take them to $8 billion. We think that's going to be nicely accretive for them. It doesn't have quite the same growth as it did a year ago, trading a little under 7.5% earnings per share growth, but 9.8 times versus its peers, 45% payout ratio with a nice dividend. So you're going to get some nice dividend growth and some, you're going to get some general rising stock appreciation. But right now, I think insurance companies are taking a bit of a backseat to the banks, and they're a better buy right now.
Mm-hmm. The next one, Brookfield making some news today, going to merge a couple of equities too, but yours in particular that we talked about last year was Brookfield Infrastructure. At least, again, down to 5%, maybe just up a touch here in the last year or so. Hard to kind of filter through all of the different, we were talking before the show about Brookfield and parts of this, but what do we make of the infrastructure in particular?
Well, a great area to be in. Why the stock isn't up in the last 12 months? Well, that's the stock market. Not everything always goes up. They've executed on everything. We picked it for inflation-linked revenues, their large organic backlog. The last 12 months, they've been very successful at buying assets at good prices, capital recycling, monetizing old assets, and replacing, and organic growth, just running their business. And, this name was cheap last year. It's same level now. It's trading at, 10 times priced to adjusted funds from operation and growing at 17%, 2025 to 2027, very visibly. If I had to put my money into just one stock on the TSX that had upside, safety, valuation, and nice dividend that's going up 5 to 10% each year, this is one of them. Okay. This is it, probably.
Let's go from the TSX to New York, too, where Uber had a very good year, especially in the last 6 months or so. But that stock now trading just under $97 US, up 35% on total return. So a very good year for Uber, too.
Yeah, the knock is that self-driving cars are going to be everywhere, and you don't need an intermediary service like Uber. But of course, they're just not doing mobility. They're also into delivery, and they're into freight, and they've been building that out really well. They've announced some good partnerships, like with NVIDIA, to get a stronger gains into the robo-taxi space, which is supportive. The stock has a $7 billion buyback. They've announced partnerships in Taiwan, UK, which really helps give them tailwinds. with these companies, you're always looking, am I buying them at the right price? And look, it's not expensive, 21 times and growing at 37%, so visibly. So I think that there's still a lot more to go with Uber.
Okay. Stay with us. We're going to be back with Greg Newman of Newman Group. ScotiaMcLeod who's going to take your questions on North American equities. We're back after this. Let's go back to the phone lines. Michael is calling from Vancouver. Hi, Michael. What's your question?
Hello, Matt. Hello, Greg. Greg, thanks for taking my call. Greg, questions on Algonquin Power. I've held it since about $15, now down about the $7.50 mark. Hate to lose on the stock like everyone else does. Just wondered what your thoughts were. Is it a hold? Is it a buy more? Or is it a get rid of? I'll hang up and listen to your response. Thanks so much for taking my call. Have yourselves a great day. Bye for now.
Yeah, what a great question. So listen, these guys really had a fall from grace, very unfortunate. The good news is that they've really kind of made it back. Their last quarter was in line. They're on track to meet their 25 guidance. And really, when you look at the energy infrastructure group, is it cheap relative to the group? Well, not that cheap. 13 times 2027. I think it's probably priced more or about the same as a Gibson, but it does have a similar growth profile right now of about 18%. So I think the worst days are behind it. This one thing, although, about you don't have to win on every stock. Like, it's okay to I would rather put new money into a Gibson, a Keyera, even an AltaGas than an Algonquin, just because they're higher quality players. But I think that if you do, buy Algonquin down here, add to it, you're going to win in the next year or two.
Okay, let's go from the West Coast to the East Coast. Terry is calling from St. John's, Newfoundland. Hi, Terry.
Hi, Greg. Hi, Matt. Thanks for taking my call. Greg, I'm looking at Aya, and I'm wondering what's your view on Aya and this recent short seller report, and how likely is it this is going to go sideways while the company responds to the short seller report? Thanks.
Well, look, we still think that they're going to have, a real nice second half. A lot of times these short sellers, I haven't read the report yet, but a lot of times, what they really want to do is just have a plausible story. It doesn't necessarily have to be true. It just has to be enough distance from the time that they short for them to lift their shorts and make some money. We like it. We think it trades at a 0.71 price to NAV. When I first discovered this company a year ago or so, I saw this huge growth rate in front of it. That's moderated somewhat, but I think when you do have a short report like this, you do want to assess it, and so I'd like to look into that more. But from what I know of the company and some of its parts, we like it. I got it. I'm not about to sell it. I'll look as to whether I should be buying more.
Okay. Let's go to Gulam now, who is calling from Toronto. Hi, Gulam. Go ahead. Gulam, are you there? No, we're going to check in. We'll check back in with Gulam. So next up, Kevin, just outside Toronto in Oshawa. Hi, Kevin. Go ahead with your question for Greg.
Hi, my question's on the TD Bank.
Okay.
It's had a really good run. Trading volumes are to decline. It doesn't seem that fast anymore. I'm just wondering, would you be adding at this level? Thank you.
I've misjudged this name. No, I wouldn't be adding at this level. Listen, I thought they'd be in the penalty box with their, U.S. misfires. But the company, to its credit, really changed its management team a lot more quickly than what people thought. Look, last quarter, they beat. All the banks had great quarters. They were better on their PCL, provision for credit loss. trajectory. Management's very confident. But, they're still going to have potential headwinds in the U.S. with their U.S. retail. So it's no longer at a discount to the group. It's trading about average, right in line, and does have decent growth rate, about 7%. But look, would I be adding to banks? I would. I'd be adding to BMO, Commerce, and there's another bank that I can't mention that looks pretty good here too.
Okay,
yeah.
Good to know. Well, I think we do have Gulam now, who is in Toronto. Gulam, are you there?
I'm here.
Go ahead.
All right. Good afternoon to you both. I've just got a GIC that came up for renewal, and I hate to put in at 2.9%. So I was thinking of putting it into ZWU or ZWB or a little bit of both. I'd like your suggestion on it. Is that a good move?
That's a great question. It depends on your asset allocation and your risk tolerance and where you're owning that GIC. Is it registered where you keep the whole amount? I like the BMO lineup for ETFs a lot, and I use them a lot. That doesn't mean I have to like every single ETF. I'm a covered call writer. I write covered calls on stocks. I don't like ETFs that as a mandate have to write covered calls. It looks nice, it looks enticing, but often, the miracle with stocks is the growth that you get from not selling calls and only selling calls selectively as a tool when you assess that a stock is really swelled. So TD Bank, I just talked about that one. On the chart, I think it's swelled. I think it's a great time to be selling a call on TD Bank. But if you're in an ETF that has to sell calls in the utilities, a year ago or 2 years ago when interest rates were high and utilities were not doing well, it was a poor time to do it. Now you've had this big swell in a lot of utilities, and I think it would be a better time. But that said, I think that there's probably more to go with the utility space with lower interest rates and with this thirst for data centers that is another really good tailwind for them.
Okay. We're going to take another quick break, and we'll be back with Greg Newman of Newman Group, ScotiaMcLeod, who's taking your questions on North American Equities. In time for a few more calls. Let's go to Moez, who is in Vancouver, BC. Moez, go ahead.
Hi, good morning, gentlemen. My question is on IFC, Intech Financial. Is it a good place to initiate a position in it? Thank you.
Wow, that is just a great question. I mean, look, we were sellers of this stock. I mean, we've owned it forever, and it's been a top pick forever. But we were tactical sellers. That doesn't mean we sold everything. But in the March concern about markets, we were looking to take profits from stocks that didn't owe us anything. One of the stocks that didn't owe us anything was Intact. So about $300 we were selling it just because its earnings rate, its growth rate, price to growth was really starting to not work as well as its peer Definity, for example, and not really well relative to the group. Look, last quarter they were great. They beat by 30%. Underwriting profitability has been wonderful. They were light on catastrophic losses. Everything you want to see, except it's grown. It's gone up too much, so it's high bar given the valuation. So right now it's trading around 14.5 times with a 4% growth rate. I'd rather go to Definity if I were going to, but that said, I'd rather go with the banks if I'm looking in the financials right now.
Okay, let's go to Quebec. Jack is calling from Montebello. Hi, Jack.
Good morning. I'd like to ask about Freeport McMoran. I hold it, unfortunately, right now. And I'm wondering what your guest thinks is the way forward for Freeport. I understand there's a class action suit being considered, so maybe it's a little early, but what about them?
You can see on the chart. Right? Thanks, Jack. We're talking about tough couple days.
This is very regrettable. Look, they had a tragic mud rush incident in Grasberg, which is their main mine. We are still keeping our 2027 estimates intact, but I think we dropped our earnings growth for 2025 and 2026 by about 27%. So the stock has really had this dire reaction. The trouble is, look, we like copper, and this is going to tighten the copper market. This is probably the best long-term play on copper on the planet. But the problem with mines, any one mine, is you have these troubles and you have these incidents. So longer term, I love it. And we're going to use this weakness to accumulate more and buy more. Short term, the next 3 months, stock's not going anywhere. It's probably going to dance towards 33, 34. But I think you want to use this weakness to add. They're good stewards of mines and operations over time. And I think the better view is they're going to turn this Grasberg incident around.
Okay. One more caller or two here from Bruce. Bruce is in Simcoe, Ontario. Hi, Bruce.
Hello, and thank you for taking my call. My question is on Merck. It seems like it's caused a lot of pain in the past year to the shareholders.
Okay.
Indeed.
Thanks, Bruce.
Indeed. Well, and what is the culprit? The culprit is Keytruda, that is going to be coming off patent, which has been their blockbuster drug, which is responsible for 40% of their revenue, or $29 billion. So how does the stock grow? But what are they trying to do? They're trying to slash costs. So they're slashing $3 billion by the end of 2027, which gives the stock some support. Look, the stock is pretty darn cheap down here, but it trades at eight times 2027, but doesn't have any growth rate after Keytruda. So stock needs to do something. They probably will, but there's better places in pharma to park capital right now.
Yeah, down over 30% in the last year. Let's go to another email too. This one from John. John saying, can I have Greg's thoughts on UPS and where it stands right now?
So UPS, like this company, first of all, you want to buy these things when they're down, right? And love the 7% dividend. Let's go back. What's wrong with it? I mean, they had a bad year. They had tariff uncertainty, high labor costs, elevated capex, high debt. I think the market really didn't like the fact that they're reducing their business with Amazon, but they're doing that because it's a low-margin business. On the upside, e-commerce continues to grow. They're looking to expand in Mexico, increase their cross-border. We think earnings are going to inflect this year, and I think it's a deal. I mean, it's trading around 10.5 times with about 11% growth rate. It's scary when you're looking for the inflection in earnings. So I wouldn't necessarily go out and buy it right now, but I'd sell puts. I'd oblige myself to say own it at $75, get paid a nice premium. If you get put in, you're going to get paid really nice to wait by this dividend.
Okay. Another email too as well. This one from Sid asking for Greg's opinion on Ford. Thoughts, Greg?
So, for years, these auto companies have not been a buy, in my view. And still, there's reasons not to buy them. There's tariff uncertainty, there's tariff-related expenses, there's stiff competition. But these guys are on track to deliver $1 billion in cost reductions this year. They got a very good balance sheet. Very inexpensive, like GM. I mean, GM, I think, trades at around 6 times earnings. This one trades at 7 times earnings. And unlike GM, they never slash their dividend, and they're going to pay you this good dividend. And their hybrid and EV strategies look really good long term. So after a tough 2025, we see really nice growth for 2026 to 2028. So I'm not a fan of auto stocks long term. They're cyclical, but if there's a time to buy it, I think it's now.
Yeah, that's going to do it for calls and emails today, but don't go away. Greg is going to share his top picks. That's coming up after the break. Stay here. Well, join us tomorrow on Market Call. Mike Philbrick will be on the show. He's CEO of Resolve Asset Management. We'll be taking your questions on exchange-traded funds, on ETFs. And if you miss Market Call, you can check out our daily podcast. You can find it on iHeartRadio and every other platform where you have podcasts. You can also watch full episodes on our YouTube channel. Well, time now for top picks with Greg. Let's get into it, shall we? A lot of talk about your first top pick in the last few days, Greg, too. Atkins Realis, at least at this point, to take us through why this is on the board today.
Well, trying to figure out names that are beneficiaries of big themes. What's a big theme? Carney's national projects are a big theme. These guys have been on fire. They beat last quarter, 3% in engineering services, 20% beat in nuclear. Margins are really improving. They're involved in Darlington in Ontario, which I say is one of the beneficiaries of these 5 projects. Their mission is to meet demand for low carbon energy here and building resiliency to climate change, repairing aging infrastructure. Meantime, their balance sheet is in just terrific shape, and trades at a reasonable 20 times earnings, growing at 37% visibly. So, folks, I mean, if you're looking around for the others, WSP, Stantec, they've been top picks of ours. We own them, but this is the one to buy now. I think it's a little bit more of a beneficiary of the federal programs and working on its own without that anyway.
And still could, even because those are the first 5 nation-building projects we've been talking about, but there's more likely coming from the federal government too.
Well, we think so, and the multiplier effect from those first 5 are pretty darn good, but hopefully they happen, and in the timeline that we're looking at, and then those other projects get added. Yeah, okay. That'd be great.
Second pick for you today is Keyera, at least at this point on the TSX. Take us through the outlook for this stock.
Well, infrastructure last quarter continues to see really good growth in this name. Another really big beat. I'm looking for beneficiaries of getting LNG offshore and LNG really ramping up in Canada. Compared to its peers, very low leverage. 2 times debt to EBITDA. The other ones are like 4 to 5 times. Very low payout ratio for this very nice dividend, 48%. That's like a bank payout ratio, even better. Their volume growth has been driving really a lot better returns on existing assets. See really nice potential for new projects as well. That's always an embedded catalyst for this name. And looking for names that are cheap and trading at 14.5 times and growing at 27%. So price to growth, this name really, really works. Very good value.
Okay. Your last one, too, is we'll get into oil and gas, shall we? Tourmaline Oil is your third top pick today.
Well, this one came down a little bit. They spooked the market a little bit in terms of their production spend. They announced a 7-year plan, which was very expensive, but they're trying to time this high production increase to coincide with the growing LNG business. Natural gas is needed for years to come for cleaner energy and as a bridge to the future. These are the largest natural gas guys in Canada. Our AECO prices have been so depressed with, LNG bottlenecks and maintenance and that sort of thing. But we see a very strong pricing, relatively speaking, for AECO and natural gas in 2026. So meantime, this name's going to pay you a decent dividend to wait, and they do have special dividends, which can be really nice for investors. Trades in line. Trades are around 6.6 times EV. Not cheap relative to the group, but not expensive either, for 9% production growth and 5% cash flow growth. So, all in, I think that this is a name that will work very well over the next 5 years.
Okay. And again, holding that too. Do you have another one too? Maybe I can put you in a spot a little bit, oil and gas, if we stay in that sector too, at least at this point, where someone else can look for at least right now?
For sure. So if you want something that's a little bit safer but with a real nice dividend, you go with Peyto. Peyto is, and that's because they're hedged out to 2026. If you want something that's really higher torque to natural gas prices, you go with AAV Advantage. So, oil stocks, I don't know. I mean, I'm not as much a fan of oil because it's manipulated by OPEC, and you got these geopolitical issues with Russia and that sort of thing. So the price of oil, I have a harder time with, but I think natural gas is an enduring theme that very much is going to help investors over the next 5 years.
Okay, and again, expecting at least maybe the role that government is going to play in the possibility. There's, again, maybe a few other factors here at play, but still you like staying there at least for now.
Absolutely, and I think the government is only helping the sector finally. It's helping the sector after many, many years of it not being helped. So I think that that's really good for the sector and investors.
Greg, thanks for being here. Appreciate your time today.
Thank you very much.
Thanks for watching Market Call today. Appreciate everyone who called in and sent us some emails. We will see you next time.